Welcome to the Energy Show. I'm energy journalist Markham Hislop, and the working title today for today's show is OPEC tanking oil prices like it did in 2014? My guest is Ramanan Krishnamooti, Chief Energy Officer of the University of Houston. So, welcome to the Energy Show, Ramanan.
Hey, Markham, thank you for having me. It's a pleasure being on the show.
Yeah, it was good to see you. We haven't interviewed you for a while, but we did previously. I'm just going to give a little background. So in 2014, OPEC increased the oil supply to drive down prices, trying to force U.S. shale producers out of business, get back market share. The U.S. companies were turned out to be much more resilient than OPEC thought. But late 2014, 2015, even into 2016, pretty tough years for the industry. And now we're hearing about they're running out of premium fields. They've sort of kind of high graded their resource. Break evens are now up around $60-$65 a barrel. And is OPEC using this opportunity to increase its supply, drive down price, and do just what it tried to do 10 years ago?
Markham, there are two sides to this story. One is the publicly advertised side that OPEC Plus has put out, which is um, we need to get production numbers by all the states in line with what their authorized outputs are supposed to be. There have been some rogue states that have clearly gone above and beyond and produced more oil than their part of their share. And clearly, Saudi Arabia, which has sort of taken the short end of that stick, is flexing its muscle and saying, you all of you better get in line, or else we're going to really tank the prices of oil, where effectively it's going to cause a challenge to the rest of the producers. So that's an internal side. That's what we're being told it is. But I think this is also an opportune moment with the president of the United States wanting to drive energy prices down. This is really an effort to take advantage of that situation and essentially come back and put the biggest producer of oil in the world back on its heels by effectively taking out the small and mid-sized companies that are there in shale and beyond. And things have changed since 2014 quite a bit. The marketplace is different in the United States. A lot of it has been aggregated under the large cap Fortune 500 oil and gas companies. They have a lot more wherewithal than others, but shareholder value is crucial. And so there will be pushback that will be felt by those big companies. Effectively, what it will result in net oil terms is a lowering of U.S. production. I think that's where we're headed to, and clearly that's going to put the U.S. oil markets very much in the tailspin that it got to that started in 2014 and continued through 2017, 2018, and really never truly did recover till after COVID.
So right now, the U.S. is the world's largest producer of 13.2 million barrels a day. Saudi Arabia and Russia are next at about 9.2, 9.3 million. And Canada comes in fourth at around 5 million. So I was looking at the oil prices today. As of a few minutes ago, Brent is at $60 a barrel. West Texas Intermediate is at 57. Western Canadian Select, which is our heavy benchmark, is at $46 a barrel. Are we getting to the point where the prices are below the break-even costs for producers, particularly in your part of the world, down in Texas?
57, you're really into that region where many of the new fields are going to really struggle to bring value in. It just that your break-in price is probably somewhere between 50 and 60, depending on the location. There are additional challenges that are there. I don't think it matters how much we deregulate the marketplace here and how much we kill regulations. I don't think that's the dominant place for the price point for oil production today in West Texas and beyond. It's really labor, it's really the cost of drilling and producing from relatively low producing fields, right? Each individual well doesn't produce as much as, say, the offshore ones or the Canadian wells. Or any of the conventional wells, in fact.
Right, but you're talking about conventional production in West Texas and other parts of Texas, whereas the shale producers can generally what you get is 18 months to 2 years of very high production, then it just falls off a cliff, and they have to go and drill another well to
Yep.
replace that supply, which means that you need a lot of capital, which means they have higher production or break-even prices, and here we go again. It's starting to look a lot like 2014. Well, let's talk
And
about the unwinding of these cuts that OPEC Plus has made for a number of years now. Apparently, had agreed to 411,000 barrels a day every month, and then they accelerated that, so that's going to start in May. It wasn't supposed to start, I think, until June. But now they're talking about if the states like Kazakhstan don't fall into line, they might just unwind the whole 2.2 million barrels a day by November all at once, which would just crash the market, and who knows where prices would be.
yeah, and also expect an economic slowing down, right? So you're seeing signs of that already setting in. The United States had a negative growth last quarter. Q1 of 25 was negative growth, and China is slowing down. We're starting to see signs of slowing down in India. We're starting to see global slowing down of economies. Now, add that to a time frame of November where you unleash 2.2 million barrels extra into the global market, and we've got all the signs of crashing oil prices down to levels that we've not seen since COVID, right? When there was momentary periods where you even had zero or negative prices. So
Now, one of the perhaps you could explain what Donald Trump's strategy is here, because it seems contradictory. On the one hand, he came in with drill baby drill. We're going to open up federal lands. We're going to increase production. On the other hand, he now has been pushing for lower oil prices, which is negative for American producers. And on top of that, he's put 25% tariffs on steel, which the producers themselves are already saying, look, that's increased our tubing and casing costs and rig costs and so on. I mean, it's got to be very uncertain because all of these mixed messages coming from the White House.
well, I think ultimately the only thing that Donald Trump cares about, and this is his own words, is having energy prices at record lows. Uh, he wants that price of oil and energy to be at record lows, and he couldn't care less about what happens to the people who produce that oil and gas. And he's pretty much said that um, effectively many times over. Um, and it is a global market, and so the long game is if you keep uh, oil production high, the demand will go up, and ultimately the demand will outstrip supply, and there will be a bonanza day somewhere in the future. But in that time, you've unleashed all the oil and gas that you could think of unleashing on the world as possible. So the whole climate agenda, the whole idea that climate alarmism is a problem, it plays into that, and short-term pain is something that I think the Trump administration is willing to take on for the larger producers if they can roll back regulations, if they can roll back environmental protection, and effectively short-term price challenges are good. It gets the electorate back to say yes. He came in on a promise of reducing energy prices. We've done that. We all can have cheaper eggs for a short period of time, but long term, I think we really are going to see a very different marketplace in the United States and everywhere else.
Well, let's talk about that. I remember a Spencer Dale letter one time in the introduction to the BP review. I think it was 2018. And that's the BP's chief economist. And what he said was there will come a time when oil gets close to peak demand at the global level. And he said at that point, the low cost producers like the Saudis will basically break out their calculators and do the calculation. What's best for us? We're the low cost producers. It costs us like $5-10 to produce a barrel of oil. Are we better off having higher prices, or are we better off having lower prices but a lot more market share? And
Exactly.
if in fact Donald Trump is going to push for lower oil prices, it seems like he's pushing the Saudis and OPEC towards that scenario that Dale talked about, where, okay, that's it. If we're going to have low oil prices, we may as well have all the market because that's the way we maximize our resource. What's your take on that?
I think that's a very reasonable take that Spencer had, right? Which was, I think that's the ultimate thesis. Are we close to peak oil demand? That's the question we have to ask. In a scenario where we were moving forward with EVs unleashed, with the idea that we are going to have much less oil demand from the traditional markets, there was a possibility of turning around and saying we probably are reaching peak oil now or the next few years. Um, I think, given the significant rollback of climate related efforts in the United States, we're starting to see this percolate elsewhere. And if the prices of oil can be crashed, I think you push out peak oil demand by about a decade at least. Um, and that's because a large part of the developing world, as we look at it, Africa, the continent of Africa dominated, and South America dominated, are going to go back and start to really embrace the oil economy rather than the alternate energy economy. Because two things. One is that you've got critical minerals in that entire marketplace being stifled because of a dominant producer without any competition in sight, and this idea that we can have oil prices so cheap that your economy can actually move much faster, much and grow much faster because you've got low energy price. So I think this idea of energy demand getting pushed out, the peak energy demand getting pushed out 10 years, 15 years, might be really the ultimate story that the Trump administration is going to achieve. Um, the Saudis are playing along, I think, in large parts because they think that they can actually become the dominant producer in order to control prices into the future. So I'm not thinking 2 years, but post Trump, who controls oil prices will be Saudi.
Let me give you the counter argument to that, Ramanan, and that is, and I think Joe Biden is largely responsible for this, and that is when he put up last May, he put up the 100% EV tariffs on Chinese EVs, and then Canada followed suit in September. China really has just turned its attention to the third world, so Latin America, Africa, Asia, Middle East, and so on. And the amount of, not only the amount of exports of electric vehicles, batteries, and solar out of China into those markets, but also their strategy of localizing production. So we have assembly plants, we have manufacturing plants in places like BYD is in Brazil and all over the
Mhm.
place. And I would argue that in fact China is the determining factor here. It's not the United States. I hate to say this. I mean this the most respectfully, but you guys are not the driver of this. China is the driver. If it executes and electrifies transportation in other markets, including its own, then I think you're toast. I think the oil production, and we're going to see a peak demand in 2030. And that, but the question then becomes, can China execute? If it does, then that changes the calculation for the Saudis, for the United States, for everybody who produces oil, including Canada. And we're not going to know that for about another 5 years. So that's my take on it.
Markham, the thing with transportation is it is not a rapidly trans. So there is a small part of this market that you can replace quickly, but the tail of this market is dominated by IC engine vehicles, and it'll be dominated for between 15 and 18 years by IC engine vehicles, even if we had a miraculous shift. So I think you've seen that early adoption happen. I think going beyond that early adoption, this is the hype curve really works here, right? I think what we are seeing has been that early part of that growth. That is the early part that could have been easily replaced. I think you will see year over year growth to be comparable to what we've seen over the last, say, 2, 3 years. Anything faster than that is going to be very, very hard to sustain because of the capital cost associated with the vehicle itself and the infrastructure to put in to help the system work. And so yes, I think you're right that China controls the long-term discussion about transportation, especially passenger transportation, and with that oil demand. But it's a slow-moving freight truck, not an express train that is going to mow it down. So you really want to think 20 years rather than 5 years if we are to expect the developing world to be the dog that's going to really run this race, because of the cost of the vehicles and infrastructure.
Then I want to run. Well, we don't want to. We could argue this all day, and it's a great fun to do it, right? We're arguing hypotheticals and counterfactuals. But my point here, I will just leave you with this one, and that is, we all focused on displacement. When do EVs, electric transportation, start to displace oil demand so that oil starts to fall? And I would argue that for the oil industry, its displacement is not the critical issue, it's disruption. Because long before we hit peak oil demand, they have trouble getting capital. They crowd out of one field into low-cost fields, low-emission field like Guyana, instead of being in the shale or wherever they happen to be. They have their climate policies are still going to be an issue in some parts of the world. You have on and on and on and on. So I will make a prediction and say that before we get to displacement, disruption will be a major problem for oil-producing countries, and I include my own and include yours as well.
Yeah, the Stone Age didn't end because we ran out of stones, right? So I remember that quote, and it's absolutely relevant to the oil world. It is not because we're going to run out of oil that we're going to have a problem with the oil economy. It's going to be by displacement. It's going to come about because you're going to have a significant disruption in the way we think about it. But I just also say this disruption, unlike, for instance, the telephone industry, is not going to be a 5-year sort of very quick disruption, but it's going to be a 20 to 25-year disruption. That's the point of what I was trying to make. I agree with you. Disruption is going to be the crucial thing. That's why I'm arguing with you whether the peak demand is 5 years out or if it's 15 years out. And that changes the calculus for how much do you get out of the ground. And I think that's part of where we see this game being played out. If we'd had a president different from President Trump in the United States with a very different view on climate policies, I don't think you would see the Saudis going and turning up the spigot.
Yeah, you could very well be right, and how there are so many uncertainties here. The error bars are so large that we could see one future, we could see another future, we could see there are multiple scenarios here that could play out depending on how this all, I mean, who could have foreseen Russia invading Ukraine in 2022? That has been a major disruption for Europe. Who could have foreseen the COVID pandemic? Who could have seen Donald Trump's tariff wars? I don't think anybody saw that really ahead of the election. So it's going to be a roller coaster of a ride. Ramanan, thank you very much for this. Always appreciate your insights.
Absolutely. Thank you so much, Markham. It was a pleasure. As always, we've gone and talked about all kinds of things, but I always enjoyed chatting with you. Thank you.
Likewise, and thank you.
Thanks.
Thanks for watching the show. We are on a mission to reach 10,000 subscribers and over 1 million views. If you're enjoying the content, give us a thumbs up, share your thoughts in the comments, and subscribe to our channel. Thanks for being part of our community.